Okay, so the question is, what do you do if you own a dud investment property? And this user said that there's no prospect of capital growth. There's just too many apartments. So it must be a high rise apartment. But the yield, the gross rental yield, is around 10%. So very high income, very low growth. If you have a property like that, what do you do with it? Well, you've got to ask yourself, what contribution will that asset make towards your meeting your retirement goals or your financial goals? Now, of course, it's going to deliver most income or some income and no growth based on the question that's asked. Well, we need to really ascertain what is that income after tax and expenses. And we also need to factor in the likelihood of needing to spend money on repairs and maintenance. As properties get older, particularly if they're new build properties, they might not be constructed to the same sort of quality as older style properties. At some point, you're going to need to spend money on these assets. And so you need to make an allowance for that. So whilst the gross rental yield might look attractive at 10%, I suspect once you subtract costs, there's probably some body corporate, so owners corporation fees, I should say, maintenance and interest, maybe you're actually not left with a lot of money. And if that's the case, then the contribution that that asset will make towards you achieving your financial goals is going to be minimal. And arguably, that money is better invested elsewhere, because that's the other thing that you need to weigh up is the opportunity cost. So whilst it might be cash flow positive, because the high rental yield pays for all its expenses, including interest, you might think, well, it doesn't cost me any money to hold the asset. Well, that's true from a cash flow perspective, but there is an opportunity cost, and there's always an opportunity cost. And the scarce resource for virtually everyone, maybe not billionaires, but virtually everyone, is borrowing capacity. The scarce resource is not quality assets. If I've got a pool of a couple of $1 million, I'm sure over the next couple of years I can find some fantastic quality assets to buy and invest my money in. Its borrowing capacity is our scarce asset. So if that asset is absorbing some of that borrowing capacity, you've got to ask yourself, what else could you buy or put your money towards in order to do that? I wrote a blog at the beginning of this year which took readers through a process on how to deal with or consider whether you should sell an underperforming asset. I published that blog on the 13th of March, 2024. I'll include a link in the comment section below this video. But I'd suggest you check that blog out. And essentially, I took you through sort of 4 questions to ask yourself. So, is your property a high quality asset? I think we can answer no, given there's not going to be any capital growth. The next question to ask yourself is, can you afford to reinvest in a higher quality asset? So that's going to really depend on your cash flow and borrowing capacity. If you can't do that, can you make any cosmetic improvements to the asset to improve its value? But in your situation, if there's not a lot of capital growth, then you probably don't want to be spending more money on it. And so, maybe selling it is the right answer. But check out that blog, and hopefully that helps you answer the question. Cheers.